Welcome to Power Charting. I'm your host, Bruce Fraser. We have another very special program for you today. We are going to continue on with the discussion of chart reading the Wyckoff way with special guest Roman Bogomazov. Roman, thank you for joining.
Absolutely, and as always, happy to be here.
So there's so much that we can observe in charts just by paying attention. There's so much nuance, so much detail in the bars, in the volume, in the trends, that the stock or the indexes themselves can reveal much about where they want to go, what they want to do, just from their own action, their own behavior. Roman, your thoughts?
So true.
Wonderful. Well, we're going to keep going with that today and continue to demonstrate the wonderful and remarkable world of Wyckoffian chart reading. So with that, what are we going to look at, Roman?
Yeah, we have to go through the Wyckoff market discussion announcement. So yeah, we're going to have an open session, Bruce, on April 5th at 3 p.m. Pacific, and anyone is invited.
It's a wonderful time. Please come join us. Go to wyckoffanalytics.com to sign up, and your information is kept in confidence. Don't share it with anybody. We would just love to have you there and have you join our Wyckoff community. So we'll see you on April 5th.
Okay, sounds great.
And so here is Tesla. Tell us what we're looking at, Roman.
Well, here's our third case study on Tesla, and Bruce and I were definitely having a lot of fun just going through this, and this was an actual anatomy of the trade segment in Wyckoff market discussion. So what is the anatomy of the trade segment? This is where Bruce and I and our students pick a stock, and we decide to trade it, to paper trade it. And obviously, I mean, like, as we do that, sometimes I would have the positions there, along the side of this paper trade, or Bruce would do the same, or students would do the same. I mean, like, it just like, people could decide individually what they want to do. But as a class together, we decide whether we are going to open the position, whether we're going to keep the position, whether we're going to add to the position or trim the position or exit the position. So this was an actual week-to-week trade that we were following since the point of entry. And Bruce, I would say that this was a really good trade. I mean, like, I definitely have some things to say, maybe around the exit, maybe like about the add-ons. So why don't we just dive into this case study? And the first thing that we usually would do is just the analysis. So we are definitely, before the point of entry, seeing a trading range, a causality that is being created. And the first question that we need to answer in any of the trading ranges studies is, what is the bias? Bias is the question number one. The second one is the timing of phase C, phase D, and therefore your point of entry. And then the third question that we've added to kind of like the body of knowledge is, what is the character of the next move? And with that, Bruce, what are your first initial thoughts on the bias? I mean, like, what kind of bias studies would we be doing in this trading range?
Well, initially, we are dealing with a downtrend of sorts. And so this downtrend is continuing to accelerate into the March lows. And thereafter, there is a stopping action and a larger automatic rally, which sets up a trading range, which does not necessarily mean accumulation. It could possibly be redistribution for another move down. And so we're at that point, we're watching the preparation of the stock as it gets ready to initiate another trend in the future. And that is where what's so important about chart reading is trying to determine the essence of whether or not it's under accumulation or distribution of sorts. one of the most important things in this downtrend, I think, is preliminary support, because preliminary support is a climactic event of sorts, high volume, wide ranging bar with a very short, brief bounce, which cannot stop the decline. The next decline is very important because it could very well be into a selling climax, and that is the case here. And the thing that sets up the preliminary support as a point on the chart is that the selling climax is followed by an automatic rally. And I actually think that selling climaxes and automatic rallies are match sets. They go together. You need one and the other to happen in sequence. And we have that very thing here. Now we have the outer bounds of a trading range. Resistance is formed at the top of the automatic rally, support is formed at the bottom of the selling climax, and we look for trading to bound between those two levels for a period of time into the future. That's incredibly valuable information that is really provided to us by the Wyckoffian approach. Ramon, your thoughts?
Yeah, the very interesting question that students usually ask, because when we look at the execution of our trades, they usually happen when? After phase C or in phase C, in phase D, in early phase E. Those are usually the places where we would be thinking about opening the position, and therefore the idea about the bias would have been formulated by that time. So therefore, students' questions usually is, well, what about phase A or phase B? Would you ever know in phase A right away what the bias is? And my answer to that always is, in some cases, yes, and in some cases, we need to have more information. Another answer that I give them, that with time, as you practice your skill, as you practice your Wyckoff analysis, you will see more in phase A and phase B, the bias characteristics. And the more you practice, the easier it is going to be to observe that, let's say, like, oh, it's an accumulation. So let's go through this really quickly, point by point. I'm just going to give you slightly, different points here, but they all will be about the idea that we're seeing some strength even in phases A and B. So as Bruce has started with the preliminary support, we're seeing that there is a lot of demand, hidden demand in this bar. The volume spike suggests that the demand is there, and right away you start thinking about the result, what kind of result this demand produces. So from the low, intraday low, into the close, because this is the open and this is the close for that bar, we're seeing that demand is actually taking control temporarily of this price move, price action. So therefore, there is some strength behind the demand. So you're already thinking like, even this could be preliminary support, this could be a selling climax at that point, but there is definitely some strength. As we go down into the selling climax, we're seeing a couple of things here. The extension below the preliminary support low is not that great for the selling climax. And if anything, the actual selling climax bar has also some demand and demand tail. That is also very important. So hidden demand produces the result right on the selling climax bar. That's really positive. Extension is not that great. That's really positive as well. The spread itself is not like extremely expanding spread. So that's also really good. So we have a second point of bullishness here. And again, this is the bullishness on the way down. So it's very confusing because the price goes down, but we're already thinking in terms of like, yeah, it looks strong. Then the actual change of behavior rally into the automatic rally high, and we see how demand is coming in. Demand is relatively high, and again, the bar, the true range of which is this from the previous close. So we're seeing that this is the best significant bar to the upside, and it's an extremely bullish bar. There is nothing else that we see before that has that type of intensity and aggression to the upside. Another bullish case here. Okay, then as we go into the secondary support, what do we see? We see some spacing between the selling climax line and the secondary support. And that also tells you that there is some kind of strength behind diminished selling, and diminished how considerably by the factor of 2. So that's also very bullish. As we go into the upthrust action, we're seeing the ability of the price to hang around the resistance, and that tells us that institutions are not necessarily selling at the resistance right away, also extremely important. And then probably the main point, and this is what we're pushing our students usually to do, especially beginners and intermediate traders, figure out later on in the trading range the change from bearish behavior to bullish behavior. And one of the very noticeable things here is the decrease of volatility as we go into the late phase B, which I usually would associate it with the exhaustion by the demand and supply. And we're seeing how selling is exhausted here. The downward spread has diminished considerably, so therefore volatility goes down. And with that, we're not having such an aggressive move down as we have had before. And we're just coming to the support on slightly elevated supply locally, and most definitely diminished supply globally. And again, diminished to which point? Again, approximately by the factor of 2. So that looks really great. And if we would look at this whole area, let's say like second part of phase B, phase C, and maybe early D, I would divide it even into 2 parts, 1 and 2. And you could see how volatility is being extinguished even more, and how selling becomes so dull, and there is really no selling there whatsoever. And for the first time, we're starting to make local higher highs and higher lows. So with all of that, you kind of create what we call a Wyckoff story throughout the whole trading range, where you see the strength on the preliminary support, strength at the selling climax, strength on the change of behavior, strength on secondary test, strength on the upthrust action, strength on the way down into the exhaustion of the last reaction in phase B, and then decrease of volatility in C and early D. And that all is on the behind the a complete diminished selling throughout the whole structure. So all of those points bring you to the conclusion that the bias is an accumulation, Bruce.
I'd like to just point out that if you look at the month of July in here, you can see in this period the volume just drying up, and the spread in the declining bars just gets narrower and narrower. And that really does show that absorption has occurred earlier in the structure, and that at higher levels, there's just this inability to be able to go down as quickly and as deeply as before, and with much diminished volume. And this is absolutely a tip-off that the stock has been well absorbed previously to this.
Yeah, and I think that the key here, like the key difference in this area, let's say area number 2 to area number 1, those reactions that Bruce is talking about. I mean, like, look at the horizontal nature now of all of the reactions that we are having. And if anything, this reaction right here is not just horizontal, it's slightly upsloping. This basically tells you that we're going to have the increase of the momentum, and this is where you want to be in this last move to the upside. So from, let's say, this and this, we go into this, and this, which basically represents, the change in the structural strength, and especially on the last one right here.
I'd just like to make a brief note about relative strength down here, because you can see the relative strength is making its lowest low in mid-May, and then retest that low in June, and thereafter these lows are higher throughout, and eventually it gets above its moving average. This really does show that the stock is starting to have very subtle strength inside of the market as a whole, and is starting to become leadership. So this is a big plus, I think.
And I would say, Bruce, that I think institutional participation will increase somewhere here in this area, as you always teach us, that you want to have the signal on the relative strength, where relative strength goes above the moving average. And you also want to have some kind of price structure at the same time, You want that synchronicity between the outperformance, relative outperformance, and just the price breaking some kind of structure. So
Absolutely.
this
Yes.
would be an interesting, but a little bit late point of entry. And that's why is our methodology, it just allows us to kind of like get in earlier, even though let's say the relative strength might still be lagging a little bit. So that's kind of like a beauty of the method. Bruce, should we talk about now the actual trade?
Please, let's do that. This is where the
Oh,
rubber meets the road.
exactly. Well, I thought that our point of entry was just right on cue. I mean, what we're doing here is, and the question here is obviously like, could we have had an earlier point of entry? I think so. I mean, like we could have entered like on this bar right here. We probably could have entered on the earlier test of the previous attempt, to shake out a little bit locally. So there are a couple of places where I would say, yeah, you could nitpick and you could, enter here. But what we were waiting for on this specific bar is a confirmation because, we're sitting in the class, there are quite a lot of people there. So we want to make sure as we enter this type of trade and someone follows it, we are in a good standings in terms of like confirming the bullish character of the trading range. So that was the whole idea. Bruce, I like how the demand is increasing on the rally. I like how before that we're having an apex with the higher lows, and that resolves with the increase in institutional volume. So that just confirms that now we could potentially, try to overcome the resistance.
This really points out a couple things. One is that we always want to evaluate our trades after the fact. We want to see how we could improve what we're doing by going back and doing these case studies as we're doing now. This is how you become better. And then the other part of it is that note that once phase C is in, then and you've identified phase C as the important test in the beginning of an upward stride, even in the trading range, in the potential accumulation, as we call it, is that you get busy and you start to trade. And so you're starting to identify those moments where you want to initiate low risk, high reward trades. And this occurs through phase C, phase D, and phase E, which are the upward trends and the pauses in those trends as you're going into a new stride of higher prices.
Mm-hmm. Well, Bruce, I see two mistakes for this trade. So let's discuss the first mistake. I think that we had an opportunity to add, and these are the places where we could have added. The Tesla gave quite a lot of opportunities here to add to the position. And I'd say that, the more I study trading, and just the technical analysis in general, but specifically trading, the more I kind of see how in a lot of cases, there is a progression in the mental strength, in the mental execution of trading. And I would say that usually students concentrate first on the points of entry, stop loss movement, and exit. And when they mature into a more mature traders, then we will start talking about when you're correct, you gotta be a pig. And that's an expression from George Soros after his 1992 trade on British pound.
Which he told to Druckenmiller, and when they were trading the pound. And
Yeah,
so
and he basically said, like, we were right. So when we were right, we should have increased the size because they were, if I remember correctly, they were betting 4%. They were risking 4%. And he said, like, we should have been like at 7 or 8 for that particular trade, even though they made over $1 billion and they broke the central bank of England. So when you're right in a specific trade, and by being right, it doesn't mean that you're right on the next day. This is not what we mean. We mean that as the structure unfolds, you have an opportunity to add to the position, and those add-ons, which I call points of no return, the price never comes back to this point. And more importantly, those add-ons, those points are confirming and reconfirming that this is a bullish case and that we are in the established uptrend. So I would say like mistake number one here is just not having enough add-ons.
Agreed. And also, I just point out that those entries that you highlighted were all pivots off of important tests of the uptrend. So attempts to pull back to the ongoing uptrend in the trading range, in the accumulation, but it's pivoting off of that and showing renewed strength, because that will happen in a good uptrend as you'll get that initial pivot. Great time to enter.
Mm-hmm. So as we go along here with the structure and everything is unfolding, and by the way, imagine guys, we are trading this in the classroom from, let's say, June into November. I mean, like this is a very long period for us in one class, week to week, discuss this and kind of like go along. I think that the second mistake was not necessarily in this area. I think this was done perfectly. I would not redo anything here. Maybe like some of the things that could have done a little bit better, but to me, this seems like that was totally efficient. What was slightly inefficient is this scale out number one. So let's talk about this. Like what are we doing there and why? And one of the things that I started doing in my own trading, especially with swing trading, is that I'm trading the volume more than I'm trading the price. I mean, like, don't get me wrong, I do trade the price and I move the stop loss according to the price, but I do analyze the volume and use the volume as the points of exit. So for instance, as we see the volume here being somewhat homogeneous with some local spikes that identify specific points of stopping action. So for instance, behind those spikes, you're going to see hidden supply, right? So stopping action number one, stopping action number two, stopping action number three, or stopping action, well, I don't see it here. So slightly less supply. So I would say that this was a little bit premature, because when we're comparing those supply occurrences, there is definitely less supply. That is a suggestion that we're going to continue to the upside. I think at that point of time, maybe there were some other factors that we were considering, and then the exit was there. So you want to come to the area where the volume changes, the volume profile changes, and look at this change ×2. So that's pretty significant. So supply has increased in this area significantly, and this is where you want to operate on the exit side. So I would say like the scale out number one was a little bit premature, but again, as I said, the rest of it looks pretty good. Why? Well, here is the climactic action. We have the gap, we have the spread increase, we have the kind of like the attempt to reverse, and all of that comes on increased supply. So scaling out here is absolutely efficient. And then as we go up, I would say that this could have been an exit point as well on the way up. And then most definitely when we break the structure, after the slowing of the momentum, and this is very important as well, just analytically to see that. So we have the climactic run, and then momentum decreases only because momentum was really, really high right here in this area. So you want to get out at the first sign of the deterioration, gap down, attempt to go up, break of the small of the local uptrending channel, and you don't want to go to this bar, which is the change of behavior bar, because those are going to be extremely nasty and aggressive, and you might not even be able to get out pretty fast, especially with options. Your premium collapses pretty fast, so you're going to lose a lot. Your options trade exit should be on this bar and on this bar alone. Bruce?
In those tiny little spread days that came right at the high, even though the volume wasn't real high, that definitely showed that there was supply laying over the top of the market and no ability to be able to continue upward with ease. So the ease of movement just wasn't there. And then the next day was, like Roman said, a gap down, widening spread, higher volume. And when you have volume off the peak like that, that's a very important warning.
And one last thought here, hope dies last. So a lot of us and a lot of you would be hoping that the price will go higher. But what about this bar? I mean, like, look at the aggression of this bar. Do you see anything else on this chart like that? And obviously the volume signature increases as well. So just based on this, the question that I would be asking here, how profound of a trading range we're going to have after this, and what are my, trading behaviors at this point? And obviously, as you see that it's so big, you just want to make sure that you get out efficiently. And if you're that late, one of the keys here is just to wait for some kind of secondary rally to come back to the previous level and just exit at a much more efficient price. Bruce?
Very good. Yeah, I agree completely. And with that, we're done, Ramon. And we'll be back next week with another case study. So see you then. Thank you, Ramon.
Thank you.